Now, I've got a couple of slides which I've taken from a presentation I did on the future of real estate investment. And then I'm going to move on more to a more strategic piece about basically pricing and where pricing is across Europe. This full report is available. It was done for IPSX, if anyone's heard of the new property exchange for real estate. So it's called the Future of Property Investment because we want to sort of imagine how the world might move as the industry adopts a bit of fintech. You can see there on the top left-hand side the size of the commercial property industry. Now, just as quickly, is everybody remotely interested in commercial property, or are you all interested in residential property? Right, I've got one hand, so I'm going to talk to you, sir. Oh, that's okay. Good. Excellent. Because the commercial property is slightly the small relation there. So you can see there the size of the market in the UK, about 935 billion. But that's absolutely dwarfed, basically, by the residential market, which is up there in the many trillions. So it's a really the small cousin. Now, it's not all in the investment market, of course. Some of it is in the owner-occupied market, and it's split pretty much 50-50. And one of the implications, I think, of technology, and it does have the sort of opportunity to move some of that owner-occupied stock into the investment market. So who owns all of that stock? So we've got the breakdown here. This is all data taken from a report by the IPF. It's the end of 2017. And we've got the bars there for who owns UK commercial property. And you can see now that one of the biggest owners of UK commercial property is actually overseas investors. We then got the co-investment scheme, so that allows the retail man on the street and the institutions all to invest in the sector. But the absolute small one right at the bottom there are the private investors. So actually it's a market where the private investors really struggle to get any traction because it's just quite a big sector. You don't get much change when you're buying a commercial property asset. And I think one of the big changes we're going to see over the next 20 years as we see the adoption of financial technology is the ability for private investors to actually get a exposure to commercial real estate. And I've sort of got listed on the left-hand side what I mean by commercial real estate, retail, office and industrial. Now, why on earth would you want to? Why would you actually want to get an exposure to commercial property? Well, quite frankly, it's because of the return. That's why we do investment, we get a return. And the investment track record of commercial real estate, it compares very, very favourably to equities and bonds. So it's a market that's very attractive, but it's very difficult for the private investors to get into. Now, I've already mentioned that this is commercial real estate, it's not residential real estate. Now, is there actually a difference between residential and commercial? Well, the key difference is actually the pricing. So if you're investing in residential real estate, the price is going to be set in the owner-occupied market. If you're investing in commercial, it's a cash flow driven return. So let's think about our return. I've got my little building there. That's my return from real estate. And on the left-hand side, we've got the bond characteristics of real estate. And on the right-hand side, we've got the equity characteristics of real estate. So bond characteristics, clearly it's the rent less your irrecoverable costs. Look on the right-hand side, it's your capital growth minus your capital costs. And if we sort of look on balance, you can see it's more driven by income and it's less driven by capital growth. So what we have here is a cash flow driven investment, but it does have a very high cash flow bond income driven component. Now that's important because we have to think about how we're actually going to devise our strategy and how we're going to invest in this sector. Which way around shall I go? I'll go this way around. So let's think about growth. So where do we get capital growth from? So we get it from an increase in the rents, what we call rental value growth. In the long run, that actually tends to be below the rate of inflation, so don't get carried away when you're doing your appraisals. It's going to cost you money because these buildings take money to actually retain. However, it does give you the opportunity for active management. And this is where I'm going to introduce my asset manager there on the right-hand side. So asset management, absolutely key for commercial real estate. Why do you need an active asset manager? You need them for effective maintenance because it's a very expensive asset to maintain, so you need the skills for the maintenance and refurbishment. You also need them for spotting the opportunities. We move round, we look at the income side, we're interested in the income. The gross to net in commercial real estate, every bit as important as the gross to net in residential. So we need good management to reduce that irrecoverable costs. And then of course, quite simply, if your building's vacant, not only are you not getting income, you're incurring more costs. So the asset manager also maintains your occupancy. So when we think about commercial real estate, I tend not to think about it in isolation. I always think about it linked to the asset manager. You get expertise in commercial and you need that expertise, whether it's in shopping centres or industrials or logistics. There's something else we need, and that's our umbrella. That's our diversification. Diversification, absolutely essential. It's a very large asset class, so obviously you need quite a lot of assets to diversify the risk. But we're diversifying risk across tenants, across leases, across locations, and across property types. So diversification, absolutely crucial. So that's a little introduction to commercial property. As with any asset class, obviously we've got to look at the fundamentals, and so we're going to look at the outlook, and we're going to look at pricing. So this is now a forward-looking few slides. So let's think about the global economy today. Well, it is slowing, so we are into a slowing global economy. It's been very badly hit by the American-Chinese trade war. It's had a surprisingly large effect on the global economy. Italy moved into recession. Germany is very close to recession. If you look at sentiment surveys, not just in Europe but elsewhere, those sentiment surveys are pointing to weaker growth ahead. France clearly got issues with their protesters. That's the bad news. The good news is that monetary policy, the Fed has indicated they're no longer going to be raising rates. So this is quite crucial. So for pricing, the fact that we're no longer into that prospect of higher interest rates in the US. Everyone remember November? It was fun. Actually, it was Shocktober, wasn't it? It wasn't November. Shocktober, they called it. So what happened in Shocktober? US interest rates went to 3.25%. So we now know what happens if interest rates go above 3%. Basically, asset prices all around the world fall 10, 20, 30%. So they're well below now 3%. Also, we've got very low unemployment, and that's actually starting to feed through into some real wage growth. So we're actually seeing some quite surprisingly strong domestic demand growth. Clearly, retail's got other issues with e-tailing, but actually, in terms of domestic demand, it's very supportive. So that's the sort of economic forward-looking bit. So it is looking a little bit weaker. If we look at the capital side, this is just some bars showing investment. These are numbers from RCA showing the investment volumes by quarter. Now you can see we are a little bit below maybe the peaks of sort of 2014, 2015, but we're still seeing some very robust levels of transaction volumes. The line there, that's an index of prime capital value. So you can see that that investment has met some big increases in prime values. So the question today is commercial real estate attractively priced? Well, these are yields. So everyone familiar with the term yield? So basically the income divided by the capital value. So the lower these lines on the bars, basically the higher pricing. And you can see that pricing today is actually below, or yields are below, pricing is above where we got to before the global financial crisis. So we're in a market where commercial property pricing across Europe is actually incredibly strong. So is it too strong? Are prices going to fall? Well, the first bit of evidence we can look at is we can look at the stock markets and have a look what they think. So dividend yields on the left, we'll just ignore those. We'll just look at the pricing on the right. So this is showing the NAV as a premium or a discount. So if the stock market is predicting prices to rise, these lines are going to be above. If they're predicting maybe prices are going to fall, they're going to be below. So you can see our stock market friends, they're expecting a bit of weakness in the real estate market. You can see the weakest bit is the UK. So for those of you exposed to the UK market, not hugely reassuring. I'm going to show you a slightly different version of that slide now. This is splitting it out by sector. And here we see a slightly nuanced story. So it's not UK bad, everywhere else not so bad. this is actually splitting it out into the different sectors. And our weakest sector is retail. So basically this is pricing in the huge issues that we've got at Into, we've got at Hammerson with the future of shopping centres. And we've got some premiums as well. So if you look at the stock market for advice, where do they think you should be putting your money? Into industrial. Now this is one of the nice things about commercial real estate. You all understand what's going on in the economy. You all understand in your day-to-day world what the impact of things such as new technology, e-tailing, driverless cars, etc. Industrial is clearly benefiting from one of those trends, which is the move to online retailing. We are going to need an awful lot more logistics space, and we're also going to need an awful lot more of in-town industrial space for that last mile logistics. The stock market thinks that's going to push up prices further. You can all take a view on whether you think that's got further to go or not. In fact, we had a debate in our office about how much further this trend has got to go. In my view, quite a long way. So pricing is incredibly high. Why is pricing incredibly high? What is it about commercial real estate? Well, one of the things is that other asset classes, pricing is also incredibly high. So these are bond yields. So you can see on the left-hand side, down to the right-hand side, we've seen a continual fall in bond yields over that period. So I was predicting bond yields would rise just about every single year on this chart, and every single year I've been completely wrong, which is slightly unfortunate. And indeed, in the last few months, bond yields have actually come down. They've not gone up, they've come down. So although prime yields on commercial real estate are incredibly low, the comparator, the bond yields, they're incredibly low, and they're getting lower. So if you think we're in a low interest rate environment for the foreseeable future, then you think commercial real estate is well priced. If you think we're in for a shock and bond yields are going to go back up to 3%, so bearing in mind that when US went to 3%, we saw a 20% fall in stock markets around the world, might give you an indication for the ceiling of where bond yields can go. Why are bond yields going lower? Because inflation is definitely on the wane. You can see all the way across the world, inflation is actually on the decline. So all the fears that we were going to see inflation going up and bond yields having to rise, the opposite is in fact happening. That's a bit detailed, I'll spring over that. So in fact, when we think about pricing, we can't just think about pricing in isolation. We've got to think about pricing versus what else you're going to do with the money. So this simply takes the yield on commercial real estate and it deducts the bond yield. There's a premium. So if we go back to 06, 07, it was a discount. So you actually got more money putting your money in bonds than you did investing in commercial real estate. Today, you're still getting a nice premium. That's very attractive. And that's why commercial prices are so high. It's because on a relative basis, they're actually still good value. So that's my summary. Prime yields are at historic lows, and the REIT market is pointing to some weakness ahead, but a lot of that weakness is focused on retail. Massive, massive question for you all. When you're investing, what's going to happen to bond yields? Because if bond yields go up, commercial property prices are going to fall. However, look at inflation, it's going down. So interest rates probably not going to go on the rise, and that means that spread over bond yields is very attractive. Thank you very much.
Thank you, Mark. Just got a question for Bob. Straight up, hand straight up.
Actually, I have two questions. The first one is like, how do you think it's going to influence the crowdfunding trend into the price of industrial, commercial properties? You can even split it in detail if you want, like about office or commercial or like the type of property that might be affected more. And second, especially for office spaces, like how is the co-working or residential co-living?
Well, co-working's
like affecting a lot? Is it, do you have some numbers, for example, in London? We know now that WeWork is the biggest renter.
I can't remember exactly what the percentage is of space in London, but it's a pretty high proportion of space. I mean, it's not high, but you can actually see the proportion of space now leased by WeWork, and I think they announced another building today. So co-working is another trend. So it's a great industry to be in because you can see that trend and you can think, what do I think that trend is, what's that going to do to office prices? So this is my view. you can all take your own view. So what WeWork proved was that organisations, not just small organisations, but also organisations wanting to outsource a bit of space, a bit of team working, that kind of thing, what they proved was they were prepared to pay very high prices, because WeWork basically charged the highest rents in London, to take very good quality space where things were taken care of, such as your reception, your meeting rooms are there, your coffee's there, the loos are organised. And they proved that. And they proved that in a way that Regis didn't before them in the UK. So of course now we've got copycats, so there's now all sorts of different co-working space out there. So I think co-working space is really here to stay. And I think what it's proved is that the grade A, top quality office property is going to be basically occupied by occupiers that used to take poorer quality space. So I think we're going to see less poor quality space in the market forever, and we're going to see more very good quality space, which will be different. It'll be quirky, WeWorks are different. If you go around their different offices, they're not all the same. So they're different. So it's got to be good for the office market. My view of WeWork, when will they go bust? Probably about 8 years' time, but give or take 2 or 3 years.
Will this increase prices? Will this decrease prices in the market? What's your opinion on that?
Well, the thing about markets is office markets, if demand goes up, supply goes up. So then if demand goes down, supply's gone up, so you're going to see a fall in rents. In the long run, every single office market around the world, in our view, rents will grow at inflation minus 1%. It's a very simple rule. It means I can come into the office quite late, not really do much analysis, and every single office market I have the same assumption. However, that rule has held so far in every office market we've ever looked at. So the impact of WeWork in the short run is that actually rents in London are a little bit higher than they would have been. In the long run, not really going to make much difference, but it does mean we've got more grade A space and we've got less grade C space. So more opportunity for development.
Okay, and crowdfunding?
I didn't understand that question.
Okay. Now, how is going to influence the market, the commercial properties, the funding money that is coming to the market?
Yeah, so in my view, what should happen going forward with Proptech or Fintech being applied to property is we should see more money coming through different channels and basically bypassing the existing route, which is you put your money into a fund or pension funds, and that money then goes through the institutions and invested in real estate. It's quite an expensive process, and it has huge issues with liquidity, and I think there are better ways to organise the industry.
Got a question down here?
Yeah, okay. I've got 2 questions. One is because the
Everyone has 2 questions.
2 questions now.
Yeah.
Okay, so very quick one. The first one is because the chart ends in 2018, we're already 2019, so I don't know if you can disclose to us, are you betting the trajectory will continue, or it will have some inflection point and it reverse the trend at some point? Because I saw the few years before that, it actually changed direction. So that chart would tell me that for someone who's
What's the question?
so whether his opinion would be would continue or no.
What's the outlook for commercial property prices? I think they're going to remain incredibly high for probably an extended period of time. Real estate is cyclical. It always is. So things will become overpriced. At the moment, we're quite keen still on industrial, but it's going to turn into a bubble at some point in the next few years.
And then,
Time for one more. Like that?
What's the future of retail in your opinion? Retail is going down. How do you see that the stocks oversupply?
Yeah. Well, we think the stock market's got it about right. So we think that rents in retail have to fall. They've already fallen. You've got to remember that. So in real terms, they're already down about 10% in the UK. We think they've got about another 20% to go. So if you look at Next, they're talking about seeing a 30% cut in their rents. So in our view, a lot of the damage has already happened. So our actual house view is that this week is the worst week in retail that we will see in the UK. This is it. You're living it now. So our high street is dying now at the fastest rate that it will die. It'll still have some troubled times ahead. But the beauty of that is, what we're basically saying is, next week is the time to go bottom fishing in retail. So when you go bottom fishing, you are looking for distress, you're looking for stuff that is very, very attractively priced, and you are basically hacking that deal down. You are taking the rent that's being offered out and saying, I'm going to halve that. You're taking the price, you're going to say, I'll pay half that. So if you can get it at a quarter, that's when you should start buying. But this is the opportunity. You don't make big money in real estate betting in hot markets, because you're just going to pay high prices and you won't get a very good return. You've got to basically invest in markets when everyone else is going, what are you doing putting money into retail? Have you not seen what's happening? So this is the worst possible week. So Monday, go looking for retail.
You heard it here. Thank you, Malcolm.